Is the Fed responsible for the banking problems we've seen?
Well, this is a really good question. If you think about where the losses are taking place in the U.S. system, what we saw at Silicon Valley, what we saw at Signature, was that they were taking too much interest rate risk, particularly in their hold to maturity books. Where did that start from? It's very clear in the data that that started with QE. It started with forward guidance, which was the explicit intent of those programs. Remember, this is the way the Fed told us those programs were supposed to work. We want you to buy more interest rate risk. We want you to take more duration risk. And that's what piled up on those banks' balance sheets. So yes, we can directly attribute losses in the banking system to the Fed's policies of the last decade. Now, does that mean the Fed is at fault for this? Look, it's clear there was bad management at these banks, and that ultimately led to poor risk controls and the failures of the weakest links in the system. But the systemic losses we're seeing are exactly related to QE and forward guidance. There's no escaping that.
So, as an investor, if I am interested still in owning the banking stocks or some part of the financials, how do I assess that I'm going to be safe as a private investor? Because it seems to me that it's all well and good to say that, you know, the Fed and everybody else is going to come to the rescue of the depositors and the customers, yes, but we're going to let the private investor hang if they own the equity or they own the bonds. How do I then go through the next layer of due diligence to make sure that I'm buying an organization that doesn't have an idiot as FD who is lending money out long at lower rates than they're having to borrow it short term?
Okay, so I think this gets back to looking at the differences across countries. So the Fed's policies were very much targeted at trying to push you out the yield curve. So as you saw with US banks, they took more interest rate risk. Banks can also take more credit risk. Now, with the US economy still doing very well fundamentally, we've seen it in employment reports, we've seen it through CapEx measures, everything. I think any of that we're not going to see until recession. That was something you were already going to have to deal with as a bank investor.